The Bank of England kept rates at 3.75% on Thursday and almost immediately warned that may not last. Governor Andrew Bailey called it an active hold, not a pause, not a reprieve. The MPC voted 8-1, with chief economist Hugh Pill dissenting in favor of an immediate hike to 4%. That split tells the story more honestly than the headline number does. The mechanism runs through energy. Since the U.S.-Israeli war against Iran began in late February, the near closure of the Strait of Hormuz has removed an estimated 500 to 600 million barrels of crude and refined products from global markets. Brent crude was trading at $114 a barrel Thursday, down from Wednesday's $117, but still far above any pre-war level. Oil briefly hit $126 earlier this week. The Bank of England is not trying to fight the price of oil. It is trying to prevent that price from embedding itself into wages and contracts in a way that keeps inflation elevated long after the war ends. That distinction matters. The bank laid out 3 scenarios in its April monetary policy report. In the worst case, oil peaking at $127 and staying above $100 through mid-2028, inflation could reach 6.2% in early 2027 and remain above target for 3 consecutive years. That scenario would, in the bank's own words, likely warrant a forceful tightening in monetary policy. Rates could climb back toward 5.25%, reversing all 6 cuts made over the prior 2 years. In the middle scenario, 2 hikes to 4.25% are the baseline. Even in the most benign case, oil falling back rapidly, at least 1 hike remains on the table, and unemployment rises to 5.45% regardless. Bailey's language was calibrated but unmistakable. He told reporters the bank faced a difficult judgment call in coming months, and that waiting for hard evidence of second-round effects would leave policymakers too late to act. He explicitly declined to push back against market pricing for at least 2 hikes in 2026. Financial markets moved accordingly. Bets on BoE rate increases this year settled at around 0.61 percentage points post-decision, down from 0.76 before, but the direction of travel was confirmed rather than reversed. That same Thursday, with Bailey still speaking, the FTSE 100 closed up 1.6% at 10,378. It was a rally built on 2 simultaneous signals that pulled in opposite directions. Oil prices eased from their highs, which relieved pressure on rate hike expectations, and a wave of corporate earnings landed, some of them genuinely strong, others carrying warnings that will compound in the months ahead. The divergence runs along a single fault line: exposure to the domestic UK economy versus exposure to global energy and emerging markets. Standard Chartered reported a record first quarter, with profit before tax up 17% to $2.5 billion and return on tangible equity at 17.4%. The bank absorbed $190 million in Middle East-related impairments and still held its full-year guidance. CEO Bill Winters credited the bank's advantaged market presence, meaning its earnings are anchored in Asia and the Gulf, not in UK high street mortgages. Lloyds, by contrast, posted better-than-expected results, but warned that the Iran war would weigh on the UK economy, and its shares fell 1.5% on the day of results. BP's profits doubled as oil prices surged above $112, drawing condemnation from Energy Secretary Miliband, but demonstrating the arithmetic bluntly: every dollar on the barrel adds directly to BP's margin. The damage on the domestic side is accumulating. Premier Inn owner Whitbread cut 3,800 jobs, explicitly blaming labor's tax hikes alongside the war's impact on consumer spending. High street sales recorded their steepest drop in over 40 years. Unilever confirmed price increases are coming as supply chain costs rise. The UAE's departure from OPEC, a structural signal that Saudi Arabia's grip on cartel discipline is weakening, adds a further layer of uncertainty. Russia's Deputy Prime Minister Novak was explicit: the global market is in a deep crisis, with demand exceeding supply, and recovery will take several months even after the conflict eases. A fragile ceasefire remains in place, but U.S. Central Command has reportedly prepared plans for fresh strikes on Iran if negotiations stall. 2 variables now determine how this resolves. The first is oil duration. The BOE's 3 scenarios are not vague. They map specific oil price paths to specific rate outcomes. If Brent holds above $100 into late summer, the June meeting becomes live for a hike, and Deutsche Bank's forecast of a July move comes into focus. If the Strait of Hormuz reopens and prices fall toward $80, the bank gains room to pause without losing credibility. The second variable is second-round effects. whether energy costs pass through to wages in a way that makes inflation self-sustaining. That data will not arrive cleanly before June. The weight of current evidence tilts toward at least one rate hike before year-end, possibly two. Bailey did not close the door, he opened it wider. Markets priced that in, and gilt yields fell marginally as participants judged the BoE's caution to be temporary rather than structural. But that reading only holds if oil does not re-escalate. Reports of fresh U.S. military planning for strikes on Iran have not been confirmed, and Axios's reporting on short and powerful strike options represents the tail risk the BoE cannot model. The recovery scenario is real and worth holding alongside the base case. If ceasefire terms solidify and crude slides below $90, as it did briefly when Tehran reopened the Strait of Hormuz in one prior instance, the BoE's own Scenario A points toward rate cuts resuming by late 2026. Berenberg has flagged exactly this possibility. Two benchmarks to watch: Brent crude at the close on Friday and the next BoE meeting on June 19th. If oil is still above $110 when June arrives, Bailey's patience wearing thin becomes the MPC's dominant framing. If it is below $90, the calculus reverses. The one thing that would prove this entire read wrong is a rapid diplomatic breakthrough, and there is, as of now, no sign of one.